Welcome to Ekcel Academy. This is a live session on securities, laws, and capital markets. Our today's discussion is going to be Introduction to Capital Markets. But before we go ahead and start discussing about the capital markets, it is very important for us to understand the basics of this particular subject. So going through the basics, all of us know the securities, laws, and capital market is a part of module 2. It is paper number 6. Which is called as SLCM, that is Securities, Laws, and Capital Markets. This entire subject is for 100 marks. And it is a written theory paper. Right? And this paper, though we call it as a theory paper, most of the questions that are asked in the exam are practical based. So they are going to check your theoretical knowledge by asking you practical and case study type questions. Right? So it is very important for us to focus on the theoretical concepts. If you're thorough with your theoretical concepts, you can ace in this particular subject. So going to the details of the subject, this entire subject is divided into two parts. Part 1 is securities laws and part 2 is the capital market and intermediaries. By the name itself suggests security laws is part 1. And anything related to the capital market is given under part 2. Part 1 is for 70 marks and part 2 is for merely 30 marks. Now, what is the objective of this particular subject? Why have they introduced this into our syllabus? So talking about part 1, which is securities laws, it is to provide expert knowledge in legislations, rules, regulations governing listed entities on the stock exchange. So the securities laws and capital market subject is mostly applicable to the listed entities. Talking specifically about securities laws, it is applicable only to the listed companies. What are the listed companies? The companies which are listed on the stock exchange of the country, which have raised money from the public. Right? Those companies are called listed companies, and any rules, regulation, and laws which govern these listed entities are covered under the provisions of securities laws. And this is mainly governed by the Securities Exchange Board of India. All rules, regulations are brought in by this regulatory authority. Coming to the second part, capital market and intermediaries, it is to provide you the basic understanding about the working of the capital markets in the country. So when you compare these two topics, this particular part 2 is giving you the basic understanding about how the market itself works. And this part 1 talks about the rules and regulations. So going from the practical point of view, to understand what are the rules and regulations, it is very important for us to have the basic foundational knowledge about how the market operates. What are the participants in the market? What are the roles and responsibilities of these participants? Until and unless you don't know the basic aspects, it is not possible for you to understand why a particular rule, regulation, or law has been framed in a particular way. So that is why whenever we study the subject SLCM, it is always better to start with part 2. Once you're thorough with the functioning of the market, then you go ahead and see what are the rules, regulations, and legal provisions. So keeping this in mind, we are going to discuss part 2, that is capital market and intermediaries. And with the same motive, now in your syllabus of 2017, the subject is named as Securities, Laws, and Capital Market. But since you have to know the basic knowledge of capital markets and only then you will understand the provisions of securities laws, in the new syllabus of 2023, they've changed the name of the subject and made it Capital Market and Securities Laws. So the correct way is to study the capital markets first and then understand the securities laws, and that has been adopted even by ICSI when they have drafted the new syllabus. So with this basic, let's go ahead and see what and how this part 2 has been divided. So the entire part 2, that is capital market and intermediaries, has been divided for 30 marks. So this entire 30 marks is split over 2 chapters. Chapter number 15 and chapter number 16. So this area is the scoring area. Okay, in SLCM, you can easily score 20 to 25 marks here if you are well versed and thorough with each and every concept that has been asked here. So part B is extremely scoring if you focus well on the topics. Talking about the 2 chapters under part 2, 15 is divided into 3 parts. One is basic introduction. Introduction to the markets in India. How are they classified? Primary market and secondary market. And lesson 16 only talks about the security market intermediaries. But since our focus area today is capital market, introduction to capital markets, we are going to restrict ourselves to lesson number 15. Coming to the topic of discussion for today, that is lesson 15. And lesson 15, the name of the chapter is structure of capital market. Okay, so this lesson number 15 is also further divided into 3 aspects. First one is the basic introduction to financial markets. Second one is primary market, and third one is secondary market. Our entire focus of discussion for today's session is going to be the first part of lesson number 15, that is introduction to the capital markets. Okay. Now, capital market forms part of a bigger market, which is the financial market. So that is why for us it is important to first understand what are the financial markets and then come to the understanding of what are the capital markets. Coming to financial markets. What are financial markets? Any market is a place where you buy and sell a particular commodity, good, or you provide certain services. Talk about what's finance, where any money or monetary considerations are involved, that is known as finance. Where money is involved, that is a financial aspect. So where you combine these 2 things, finance and market, that where you can actually invest your money, you can buy and sell money, in the sense you're giving money and expecting certain returns out of it, is known as financial market. Market where you can invest your money and expect returns out of it. What is the basic meaning of financial market? It is nothing but a place where there is efficient flow of investment and savings in the economy in order to facilitate the growth of funds for producing goods and services. So the most important thing is that as people in the country, citizens of the country, have certain surplus money with them. On the other hand, there are business houses who are in need of funds to undertake their business activities, whether that might be production of goods, production of services, expansion of their business, establishing new factory places, establishing new manufacturing units. All these require a lot of funds and capital investment. But because the businesses or the entrepreneurs might not have sufficient funds to start their business, they will be looking for opportunities for raising their capital or raising the money to run their business. At that point in time, they will look for options to source funds, to source money. And first, the traditional ways, they will approach banks and financial institutions as asking them for borrowings to run their business. But that is the traditional method. Now we have moved ahead with the development of the other aspects of financial market, whereby the regular investors, regular individual investors who are earning salaries, who are running their business over and above their expenditure, they will have certain amount which they have as a surplus money. After removing all their expenditures, all the requirements that they want to carry on their living expenses, over and above, they will have surplus money. What will they do with that surplus money? They want to what? They want to increase the value of their money. So one aspect is that if they have surplus funds, why don't they provide this money to the business? And the business, when it is going to earn profits, it is going to give that money back to the investors with growth in their money, whether it is in the form of dividend, whether it is in the form of increase in the capital, that is increase in the price of the shares, or whatever be the mode of returns. So this is the aspect of financial market where they help in channelizing the money from the people who have extra money to the people who are in need of money for growth of the business or growth of the business entities which are producing goods and services. If the businesses grow, then automatically the economy of the country is also growing. So the financial market will help flow of investments and savings from the people who have it, that is nothing but the investors, to the people who want it, that is nothing but the business houses, or in certain cases, government entities. So people, whoever have surplus funds over and above their expenditure, whatever they require for their day-to-day living expenses, whatever they want for their luxurious life, after that, whatever is spending, that is called a surplus fund. And people with the surplus fund invest in the securities with the objective of earning returns on their investment. Nobody is just going to give back 100 rupees to some particular person and say, after 5 years, please return this back, return the same 100 rupees back to me. So if he's giving his money for a further period of 5 years, he will expect that his money will also grow with time. Because all of us know that 100 rupees today is not equivalent to 100 rupees tomorrow. You expect that your money also grow. You earn certain kind of returns when you're making investment. Even when you have extra money, you're giving it to the bank in the form of FDs, fixed deposits. You are earning interest on your fixed deposits, right? So you are getting returns on your investment. Similarly, the people who have surplus money, if they're investing in the financial market in the form of securities, that is in the securities market, they will always invest with the main objective of earning returns. And there are returns which can be of multiple forms, which we are going to focus in the upcoming time. So the financial market enables the first and foremost thing, it is the transfer of funds between the lenders and the borrowers. So these lenders can be banks and financial institutions. It can be the actual investors in the stock market. Borrowers can be business entities, can be government authorities, government bodies which are in need of funds, etc. They create securities for investment. So when a particular person is investing his money, the lender is investing in your company, is investing and giving money to the borrowers, they will need certain kind of acknowledgement that you have given a certain amount of money to them to run or carry on that business. And that instrument is called as securities. And it facilitates efficient trade of securities. So not only in creating the security, but thereafter trading, buying and selling of those securities also is an important aspect. So the main function of a financial market is for channelizing the funds. People who have extra money, that money should be put into productive use by giving it to the people who are in need of those funds. So the main primary focus of the financial market is mobilizing and channelizing the funds between the lenders to the borrowers. Yes, so that is the financial market. Now, what are the main functions of the financial market? Like I told, the first and foremost is channelizing the funds. What does this mean? Giving direction to the funds. Instead of keeping the funds idle in the bank accounts, it is better that money can be utilized by giving it to the people who are in need and thereby earning returns out of the same. So it mainly facilitates mobilization and channelizing of savings into most productive use, that is by giving it to the people who are in need to carry on the business. Second one is price determination. This financial market helps in determining the price of securities on the basis of their demand and supply in the market. So the basic concept of economics that the price of the goods and commodities are based on demand and supply in the market. Same principles apply even in the financial market, where now most of us are aware about how the stock exchanges function. Depending upon what is the demand and supply of shares in the stock exchange. Depending upon that, the price is going to be determined. And here, everything is determined properly. There is transparency. Okay. Why is it? Because it is a market that is regulated by the Reserve Bank as well as the Securities Exchange Board of India. So the market itself will help you in determining the price because it is completely based on demand and supply in the market. Coming to liquidity. What is the meaning of the word liquidity? Liquidity clearly means how fast you can convert any particular asset into cash. How fast we can convert the asset into cash. That is known as liquidity, right? So the more the liquid the assets, the better it is for the people who are holding that particular asset. Why is that? In case they are in need of emergency funds, okay, what will they do? It will take them very less time. They can sell off their securities and get cash. On the other hand, if they have buildings, if they have property, it takes a long time to find a buyer for it and then sell it. It will take a longer time for your property or building to be converted into cash. So the real estate sector is an asset, but that is not liquid because for converting that asset into cash, a considerable long amount of time is required. On the other hand, when we talk about these securities, okay, they can be easily converted because they are traded over the stock exchange. So you can easily, whenever you want, you can buy the securities. Whenever you want, you can sell them off over the stock exchange. So that is why they are called as liquid assets. So most of the financial instruments are carrying the characteristic of liquidity. It provides liquidity to the tradable assets by facilitating the exchange, as the investors can readily sell their securities and convert their assets into cash. So at whichever moment they decide that they want to sell off their assets, they can make the decision and initiate the particular transaction. Fourth characteristic or function is cost reduction. How does it reduce the cost? Because it is regulated by the market, all information about these listed entities or financial instruments are generally available in the public domain. Okay, and that is why the market itself is providing a lot of valuable information to the public at large about the various instruments, securities, etc. So it reduces the cost mainly of research and development and other associated costs. Coming to the last one is there is no physical delivery. Talking about the markets a few decades back, when everything was in physical form, even if you had to buy a share, you had to have a physical share certificate. But now with the development of technology, with the development and growth of the time, we have moved forward from physical mode of transactions to the screen-based, internet-based facilities, whereby there is no physical delivery of these securities. You have demat accounts. When you buy or sell, automatically the transactions take place in your demat account, whereby you do not have the necessity of having actual physical delivery of those securities. So exchange is possible even without actually physically delivering the assets, that is these securities. So these are the main functions of the financial market. Moving ahead to who are the participants. Okay? This is one of the important areas that we should consider about understanding who are the basic parties to the financial market. Like we already know, one is the people who have surplus funds. We call them as lenders. And these lenders are nothing but investors. People who have extra money are going to invest their money in the financial market. Second one we know are the people who are in need of funds. Who are these? These are business houses, governments who require funds to carry on their activities of either producing goods or providing any kind of services. And these are known as borrowers. But because they are borrowers and people or the investors are investing in money, they are going to issue securities for the investments that are being made by the investors. So they are called as issuer of securities. Their primary role is borrower. They are borrowing the money from the investors, but they are also issuing securities in lieu of the money that they have received from the investors. And thirdly, it is the people who are connecting these investors and the issuers with each other. That is nothing but the intermediaries. So the third category of participants are intermediaries. Okay, and these are the three main participants of the financial market as a whole. Okay, these we are talking about the basic participants. Apart from this, in specific, there are multiple intermediaries, there are multiple participants, but primarily, basically, there are only three participants. That is nothing but the issuer of securities. They are the entities in the corporate field who want to raise funds from the market, that is the financial market of the whole. These can be in the form of companies, it can be government entities, etc. Second one are the investors. They are the people who keep the market active by investing their surplus funds in the market. So if there are no investors, the entire market cannot function by itself, right? So the investors are the basic requirement for a particular market to function and establish itself. Coming to the third one is the financial intermediaries. These people act as the middlemen between the investors and the issuer of securities. They ensure that the financial transaction takes place in a smooth and safe way. They will ensure that the money of the investor that has been given to the issuer is safe. How do they ensure that the funds are transferred? And once transfer is done, how do they ensure that it is safe and secure for the investors? So that is when these financial intermediaries come into play. So these are the three basic participants of the financial market. That is the issuer of securities, who are the borrowers, the investors of securities, who are the lenders of money, and lastly is the financial intermediaries, who are helping establish the connection between the people who want money and the people who are giving their money. That is nothing but the issuer and the investors. Right? So these are the participants of the financial market. Going ahead to the most important aspect of this particular chapter is the classification of the financial market. Like I told you, capital market forms a part of the financial market. So the financial market is a wider market, which includes various other components and sub-components. So the main component is the capital market and the other component is the money market. Further, capital market is going to include the securities market, and securities market is further subdivided into primary market and secondary market. So now what is capital market, what is money market, what are securities market, primary and secondary market is what we have to lay emphasis on to understand the other provisions of this particular subject. So if you're clear with the classification of financial market, it will be easier for you all to understand the entire subject with much more ease and convenience. Okay, so now going to capital market. Now, if we just talk about capital market at large without considering it to be an aspect of the financial market, capital includes a lot of things like land, building, properties, right? All this is also a form of capital. But those markets do not come under the purview of financial market, because when you're investing in the real estate, that is nothing but any kind of land, building, etc., you are paying money. But in return, what are you getting? You're getting some kind of property. So the return on your money is not money by itself, but some other kind of commodity or product. That is why they do not come under the definition of capital market, coming under the purview of financial market. Financial market covers only those aspects where you're paying money to return and expect back in the form of money itself. Where you want to grow your money, you're giving money and return also you are expecting money itself. That is why for the real estate, we have a separate regulator, that is the RERA. Right? We have RERA provisions to govern that aspect of capital market. Here, when we are talking about exclusively securities laws and capital market subject, the financial market, we already know it is where we are facilitating funds between the lenders and borrowers. People who have money will give the money to people who are in need of money. And here the main intention is growing of your funds, expecting returns in the form of money itself. How do you double or triple your money? By making investment over considerable period of time. So talking about capital, it is a long-term or medium-term investment. Okay, it is regulated by the Securities Exchange Board of India. Talking about money market, it is the same because it is an aspect of financial market. You're investing in monetary terms and expecting the returns also in monetary terms. But the main difference between capital market and money market focuses on short-term investments. Mainly, the maturity period of these instruments is anywhere between 1 day to 1 year. Talking about the maturity, whereas on the other hand, capital market investments are for a longer duration. Okay, this is the basics of the classification. Now, let us understand each one of these markets in detail. First, let's talk about what is a money market. Money market is a small segment of the bigger market, that is the financial market, where borrowing and lending of short-term funds take place. Like I told you, it exclusively deals in short-term instruments. Okay, the maturity of these instruments will range anywhere between 1 day to 1 year. It is regulated by the Reserve Bank of India, primarily Reserve Bank of India, and the other regulator being the Securities Exchange Board of India, because the entire market, the financial market, is regulated by SEBI and RBI collectively. Money market is the primarily regulated by Reserve Bank of India, whereas the securities market of capital market is regulated by the Securities Exchange Board of India. But when the regulation of the entire financial market is taken into consideration, both these regulators have to work in coordination with each other. Whenever Reserve Bank wants to pass any kind of policy which is going to impact the securities market, it will take consultation with the Securities Exchange Board of India and only then do the necessary activity. Similarly, when SEBI is passing any rules and regulations which is going to impact the money market, it is going to take consultation with the Reserve Bank. So though the primary regulator of the money market is RBI, somewhere it is also on a secondary basis regulated by the Securities Exchange Board of India. What are the nature of transactions? So large in amount and high in volume. Large in amount means more amount is invested in this market and in large volumes. But how many people will have such large amounts of fund available with them to make these investments? So not very people are extremely rich or high net worth individuals who are having so much surplus money that they can invest large amounts, that too in high volume. That is why the people who are a part of these money market, the investors in the money market instruments, are very small in number, but they are large players. Large players means people who have a lot of available surplus money with them. they invest it in these money market instruments. So we have a very few people investing, but those few people, whoever are investing, have large sums of money available with them, and that is why they are investing in these money market instruments. Coming to the characteristics of money market instruments, the first one is liquidity. All of us know is what liquidity is, where you can convert your asset into cash very quickly. It is not time consuming to convert your asset into cash. That is liquidity. And money market instruments are very liquid. They have very minimum transaction cost and there is no loss in value. So these are the characteristics of money market instruments. What are the examples? A few examples have been quoted: treasury bills, commercial paper, certificate of deposits. These are all examples of what? Money market instruments. Right? So this is the basic of the money market, whereby we have understood that it is a market where short-term fund borrowing takes place, where the maturity period is between 1 day to 1 year, that it is regulated by the Reserve Bank of India primarily, and other regulator being the Securities Exchange Board of India, that a very few people invest, but how much ever they invest in large funds. Okay, so these are the aspects of money market. Moving to the focus area of our subject is capital market. Our entire subject SLCM is based on this particular market, capital market, which includes securities market. So from here, our focus point should increase because this is the basic foundation for our entire subject, that is securities laws and capital market. All of us know capital market is a part of the bigger market being the financial market, and that market includes the securities market. Now, what does it do? It deals with the industrial securities market, government securities market, and long-term loan market. We will see what is securities market in detail. That securities market is, like I told you, there are two: either it is the companies or the business entities, or the second kind of people who are issuing securities is government. So the government, if they are issuing securities, we call it as the government securities market. And if any business houses or companies are issuing the securities, we call it as the industrial securities market. Overall, the capital market or the securities market is a long-term market where the investment is for a longer duration of time. Who are the regulators of this market? Primary regulator is the Securities Exchange Board of India. Okay, whatever rules, regulations we are going to see under Part A, that is securities laws, is passed by this Securities Exchange Board of India. The other regulators are the Reserve Bank of India, the Insurance Regulatory Development Authority of India, or Pension Fund Regulatory Development Authority. So these are the other regulators which we will see later in this session. What are the nature of transactions that take place in the capital market? It is medium and long-term liquidity needs, and the funds are pooled and made available to business, governments, as well as individuals. Okay, the money is pooled in from the investors, and whatever money is accumulated, that money is invested in the business and government bonds or government securities, so that funds are made available to them, and then later the returns are given to the investors. This is also known as the barometer of our economy. Certain examples of capital market instruments are share, stock, debentures, and bonds. These are examples. It is just an illustrative list. This list includes many more instruments. Note, capital market includes the securities market. So securities market is a part of the capital market. Now going to the securities market. The securities market is a place where the companies can raise funds by issuing securities like equity shares, debt securities like debentures, like bonds, derivatives, mutual funds, etc. So how do they function? There are investors. They have funds. And there are huge business houses which require funds, require capital. And why is this capital required? Either to start the business, if it is a startup, either for expansion of their business or for diversification of business. Okay, there are multiple reasons for which a company might require capital. And when it requires capital, it is going to go to whom? To the investors. It is going to ask them that you please give us money. We will give you a percentage of our company as equity shares, or we will give you debentures for which we are going to give you the interest. So they're going to ask money to the investors, and the investors are going to pay the money. This money received through the investors to the business is called as the capital for the company. And this capital can either be equity capital or it can be debt capital. If it is equity, that means the equity shares are issued. If it is debt, that means debentures, bonds, etc. Those kind of instruments are issued. So now when money is given to the investors, investors will want a proof of their investment, and these securities are issued as a proof of their investment. Securities can be in any form: equity share, preference share, debentures, bonds. Okay, all these are known as securities. Those securities, so depending upon whatever is the mode of capital that has been raised, depending on that, security is going to be issued and money is going to be collected from the investors. So this is known, this transaction, wherever this particular transaction takes place, where there is a transfer of fund between the company and the investor, that market is called as the securities market. Why? Because the securities are issued. Later, once it is issued, the investor, if it wants his funds back, he can sell those securities and claim back his money. So securities market is a place where firstly, securities are issued, and secondly, those securities which are already issued are traded. What is traded? Traded means sold and bought. Buying and selling of these securities take place. That market also is called as the securities market. So there are two aspects to the securities market. First time, when the securities are issued, new securities are issued, you are bringing the securities into existence. Once they are brought into existence, we know that the main characteristics of any kind of instrument in the financial market is liquidity. So whenever this particular person wants to claim back his funds that he's given to the company, he should be able to sell off that security and claim back his cash. For that purpose, trading is important, and that trading aspect is also covered under the securities market. So mainly the securities market provide platform for two activities. The first activity is where the company wants to issue securities for the first time. That is, the securities are issued to the investors, that is the public at large, when the securities are first time introduced into the market. And second one is the people who have already bought the securities by the companies, from the companies, they will require a platform to buy or sell them at any given point to ensure liquidity. Okay, so two platform is provided for two reasons. One is for issuing securities, and second one is for trading the securities. Okay. And based on this, the securities market is further classified into primary market and secondary market. So primary market is the first aspect where we are going to give them a platform to issue new securities in the market. And secondary market is a place in the securities market, where we are going to facilitate the trading activities. The shares which are issued in the primary market will be traded in the security market. So primary market is going to be associated with issuance of securities, whereas secondary market is going to be associated with trading of those issued securities. And without these two markets, okay, these two markets are interdependent on each other. If there is no primary market, there cannot be an existence of secondary market. And if there is no secondary market, there is no point in having primary market, because then there is no going to be liquidity. And the main characteristic of the instrument is liquidity. So until and unless both these markets are not in existence, there is no proper establishment of the market. That is why both these primary and secondary market together constitute the securities market, which helps in transfer of funds from the investors to the business houses who are in need of these funds. We have understood the basic mode of what the securities market does and how and what platforms are provided. But what is the main primary function of this securities market? It is the same as that of the financial market, where we are able to allocate the savings from the investors to those who are in need for business purposes. So the transfer of funds from the investors to the business takes place in this securities market. This can be done when the investors make investment in the securities of the companies and entities which are in need of funds. So the business houses are going to issue securities, and the people are going to make investment in these securities. That is how there is going to be a transfer of money, transfer of funds between people who have savings to the people who are in need of that money. And this is the primary purpose of the securities market. Now, what are the benefits of investing in securities market? We are going to expect certain kind of returns from that investment. Okay, if you are expecting higher returns, that means the investment can be slightly risky, because if you are ready to pay so much returns, there is an element of risk that has been taken in that particular investment. And if you want to go safe, then you're going to earn slightly lesser rate returns over your investment. So that is the general rule. If you expect high returns, generally the risk taken is also high. On the other hand, if you are expecting lower returns but a steady returns, that means your level of risk is also low. So people who are ready to take risks are called what? They are called the people who are ready to take risk, whereas the people who do not want to take risk are called risk averse people. They don't want to take risk. They're happy if they get lesser interest over their investment, but they are not ready to take a risk of loss of their investment. That is why they're called as risk averse people. Now, when you're expecting returns in the securities market, what are the different kind of returns that you can earn? One, we know that securities issued, either it is equity share, it is preference share, it is debentures, it is bonds. So depending upon what is the security that you have made an investment in, depending on that, you are going to earn your returns. So the returns or the benefits can be in the form of interest in case you have issued in debentures or bonds. If you have made investment in equity shares or preference shares, your return is going to be in form of dividend, capital appreciation, and bonus shares. Now, what is capital appreciation? Capital appreciation is nothing but the increase in the value of security. Okay, securities are issued. For example, initially, when a company has issued the security, you bought one security. Let us take an example of equity share only, because equity share is a form of security. When you bought one equity share of a company, you had paid 100 rupees per share. For that one share, you had paid 100 rupees. Now, when you're going to sell that particular security in the secondary market, same one equity share is worth 1000 rupees. So your capital appreciation or value or increase in the price is 900 rupees. So this is the profit that you will make. When you bought a particular commodity, you bought it at 100 rupees. But now when you're going to sell that particular thing, you're selling at 1000 rupees. So the 900 rupees is your profit. It is the increase in the value of the security that you are holding. And this increase in the value itself is called as capital appreciation, where the value of your investment is going to increase over the period of time with the growth of the company, with the performance of the company. That is capital appreciation. That is nothing but increase in the value of your securities. And bonus is, in case the company is performing well, they have more profits, they can issue additional shares, they can issue bonus to the already existing security holders or shareholders. So the primary benefit of investing in the securities market is to earn returns, and the returns can be in multiple forms depending upon what is the kind of investment that you have made. Second benefit of investing in the securities market, it is going to contribute to the economic development of the country. How is it going to contribute to the economic development of the country? The country is going to develop with the development of the business. If we are going to generate business, we are going to produce more goods and services, we are going to have more income. We are going to able to generate more income. If we generate more income, our economy is going to perform well. But for generating this income, we need to produce goods and services. To produce goods and services, we need capital. For having capital, what again we need investors. So it comes back to the basic of the lending aspect and borrowing aspect from the investors to the companies, and that is the primary purpose for which the securities market has been created. So overall, by the establishment of this securities market, we are not only helping the individual investors to earn returns, but also the economy of the country as a whole to grow and develop. So that is the primary purpose or function of the securities market and the benefits of investing in the securities market. Moving to the classification of the securities market, like I already told you, the securities market are classified into two. One is the primary market and second one is the secondary market. What is primary market? That platform where we are going to issue the securities for the first time is called as the primary market. Secondary market is where these issued securities are traded. Traded means nothing but buying and selling of securities. Which securities? The securities which are issued in the primary market. So always whenever a security has been issued, first it is issued in the primary market. After it is issued, it is going to be traded in the secondary market. Okay, this is the basic of classification of securities market. Now let us understand in detail what the primary market does and what happens in the secondary market. These two markets are two interdependent and inseparable segments. Okay, like I told you, the primary market, if you have primary market, okay, primary market is in existence and there is no secondary market, then the investors are giving money to the business houses and the business houses are issuing securities to them in return. But after this, once the investor is the holder of the security, he has to hold it till he does not find another buyer, because he has no platform where he can offer it for sale. There is no liquidity. And if there is no liquidity, then that is not the entire function of our financial market. We want to ensure that all our financial instruments are highly liquid so that the investors can invest when they have funds, and when the investor themselves are in need of funds, they can sell off these securities and convert these securities into cash. So if we don't have the secondary market, then there is no liquidity in the market. So that is why these two markets are interdependent on each other. If there is no primary market, then what are we going to buy and sell? If nothing has been issued, there is nothing in existence, what are we going to buy and sell, right? That is why if there is no primary market, there cannot be a secondary market. And if there is no secondary market, there is no point in having a primary market, because that is not going to ensure liquidity. So these two segments are interdependent and inseparable from each other. First, talking about the primary market, like I told you, we are going to issue the new instruments in this particular market. When for the first time the company wants to issue shares, it is going to make an initial public offer, what we call as the IPO. What happens in the IPO? It is the first time the company is going to raise funds from the public at large. That is the new issue of new instruments in the market. And who can issue these new instruments or securities? It is, like I already told you, the corporate sector or the central government, state government authorities, or the public sector undertakings, or any other authorities, trust, okay, which are going to issue bonds or debt instruments. So the two kind of people who are going to invest or who are going to issue the instruments are either the corporate houses or the government and government authorities. This market is of great significance to the economy of the country, as it is through this market that the funds actually flow for the productive purpose from the investors to the entrepreneurs. So this is the main function, that the funds from the investors are directly going to go to the funds of the company, to the entrepreneurs as capital, so that they can utilize for whatever purpose they have raised the money. The primary market in which public issue of securities is made through a prospectus is a retail market. There is no physical location of this primary market. You do not have a physical place where this takes place. Okay, it is done through a prospectus and everything is done online. This market is known also as the initial public offer market, that is the IPO market. The major two types of issuers, all of us know, is the government entities or the corporate entities. In addition to this, the company also can raise capital from the qualified institutional investors by making a qualified institutional placement, or they can also issue securities in the form of ADR, GDR, or external commercial borrowings. We will not go into those details in today's session, but here we should understand what is the main purpose of the primary market. It is okay, the company is there, company is in need of funds, and there are investors who have funds. So here we are going to transfer the funds to the company, and in lieu of the funds, the company is going to issue securities. This first time transfer, when the new securities are created, it is created in the primary market, and the securities are directly issued to the investors, and the money that has been received by issuing the securities are also transferred to the account of the company itself, where it is going to be utilized to fulfill the needs of the business undertaking. Coming to the aspect of secondary market, in that case, now the company has got what it wants. It has issued securities and it has raised the required money to carry on the business activity, to expand it, to grow it, or to start it, whatever may be the purpose of requirement of funds. After the issuance of securities in the primary market, now there are investors who are holding these securities, holder of securities, and there are other investors who want these securities. They don't want it, right? At that time, the exchange among these investors, somebody wants to buy it, somebody wants to sell it, of multiple different companies. So here only buying and selling is going to take place among the investors themselves. Okay, we have crores of investors over the country. These investors are going to transact among themselves, between themselves, they are going to buy and sell. That is why in the secondary market, there is no role of a company. The company is not going to earn any money from the secondary market. In the sense, the funds are not going to be transferred to their bank accounts. Obviously, if there is more demand, their value of the shares are increasing, then market capitalization is increasing, how by the way which the company's value is increasing. But talking with respect to monetary transactions, the company's involvement does not exist in the secondary market, because it is the investors among themselves who are buying and selling the securities that they already hold, and in case they want, they are going to buy it. So this is the main difference between the primary market. Whereas in primary market, the money is directly transferred to the bank account of the company because they are raising capital by issuing the securities. Whereas in the secondary market, only trading is taking place, and that trading is taking place among the investors between themselves. They are buying and selling between each other. That is why there is no involvement of the company. The transactions do not take place between the company and investors, but between the investors among themselves. Okay, that is why when we say that we are discussing about what is the objective of the primary market, it is flowing the funds from the investors to the entrepreneurs, because only in the primary market the fund is going to be transferred to the entrepreneurs. Thereafter, they are not going to get any money from the secondary market. Going to the secondary market theoretical aspect, the secondary market is also known as the stock exchange. Stock exchange, all of us know, is a place where we can buy and sell our securities. We have two main stock exchanges in the country on the main board. That is the Bombay Stock Exchange and the National Stock Exchange. These are the two stock exchanges which are a part of the main board for the regular companies. But now with the development of time, we have other stock exchanges in place also, which are known as the SME exchange, that is for the small and medium enterprises. There is innovators growth platform for the startup companies, right? These are the other stock exchanges prevalent in the country. But the main stock exchange for the companies is the NSE and the BSE. This is the place where we are going to trade our securities, that where we can buy and sell the securities that we have got in the primary market. So secondary market is also known as the stock exchange, and it is the market where trading and settlement of securities that have already been issued where in the primary market. So the shares which are issued in the primary market are traded, that is bought and sold, and the settlement, that is in terms of money. If you're buying it, you're getting, if you're buying the securities, you have to pay the money. If you're selling the securities, you're going to get the money. So that settlement is going to take place over the stock exchange. What is the purpose of the secondary market? First and foremost, it is to provide a trading place to the issued securities to be bought and sold. Right? If any investor does not want to continue holding the securities of the company, he will require to sell it. Where will he sell it? Where will he go looking for a buyer for his security? That is when he will approach this market where he can readily buy or sell the securities. Second one is to ensure liquidity, which is one of the most important characteristics of the financial market as well as the secondary market, that is as a whole, the money market as well as the capital market. So it is very important to have liquidity. It is to provide liquidity to the initial buyers in the primary market to reoffer the securities to any other interested buyer at any price if it is mutually agreed and accepted. So this is what happens in the secondary market. One, trading takes place, and because trading takes place, it ensures liquidity to the investors of the primary market. Suppose a person has made an investment in the initial public offer of a company and he has been allotted 100 shares. Now, if there is no existence of the stock exchange, there is no stock exchange, and this investor, Mr. A, wants to sell these 100 shares, where is he going to go? Can he go back to the company and say, you reduce your number of shares and buy back the shares from me? How many times can the investors go and approach them? It is not possible, right? Hence, the establishment of the securities market is extremely important. Going to how does the secondary market function? If the investors who hold the securities want to sell it, or the investors who are desirous of buying, so both buying and selling of securities, then they can do it on the stock exchange. But can regular investors directly have access to the stock exchange? The answer is no, because they've created a systematic way. They've established a procedure of undertaking these transactions. And the law clearly says that if you want to buy and sell securities over the stock exchange, you have to do it only through the registered brokers of the stock exchange. Right? So if anybody wants to buy and sell securities, they should get themselves registered with these stock brokers. That means they should become customers of these stock brokers or the registered brokers who are going to have direct contact with stock exchange, and they are going to help you buy and sell securities. Right? So who are registered brokers? Let's take certain examples. All of you will be knowing now Zerodha, Sheikh Khan, right? All of these are examples of stock exchange, examples of registered brokers or stock brokers. They may have physical location like stock exchange, which is a screen-based, internet-based trading. So whatever takes place, we have moved from the physical trading to screen-based and internet-based facility. What is the benefits of secondary market? First one, it helps in growth of primary market and capital formation for the investors, right? And the investors in the primary market are going to have an assurance of a continuous market, that at any point in time, if they don't want to have the securities, they want to sell it, they will have a ready market available where they can go and sell their securities. So establishment of a continuous market to ensure liquidity in the market is done by the secondary market. So that is the benefit of secondary market or the establishment of the secondary market. Now, what is the main difference between primary market and the secondary market? First, talking about the meaning, we all know that in the primary market, it is issuing fresh securities. Whenever we are going to issue new securities, we are going to first issue it in the primary market. Only then that is going to be given, traded in the secondary market. So this primary market is a place where fresh securities are issued for the first time. In the secondary market, we are only going to provide a trading platform. For all those shares which are issued here will automatically move to the secondary market when the buying and selling is required to be done. So primary market is the issuing market, whereas the secondary market is the trading market. What is the objective of primary market? It is to raise funds for the business. So the money from the investor is going to the bank account of the company. Here the funds are raised and given to the business to fulfill their requirements. What is the objective of secondary market? It is capital appreciation. Like I already told you, capital appreciation means increase in the value of the securities. So this increase in value of securities is helpful for the investors because they are going to make a profit over it. And it is also helpful for the companies because their market capitalization is going to increase. What is market capitalization? And how is it going to benefit? Market capitalization will help in the valuation of the company. In case they are going to wind up their company, at what price they can sell their shares, at what time, at what price they can sell off their shares to somebody else when they are selling off the company or shutting down. For that purpose, the price that is going to be determined, it is going to be determined on the basis of this capital appreciation. What is market capitalization? Market capitalization is nothing but first one, initially at some price, you're going to make the IPO. That is a fixed price at which you're going to make the IPO. That is in the primary market. But when the security after issuing the primary market moves to the secondary market, the price is going to fluctuate on a daily basis. Why? Because the price is always going to be determined on demand and supply basis. If there is more demand, the supply is limited, because once the company has issued 100 shares, only 100 shares are going to remain in the market. Thereafter, it is the demand that is going to determine, right? If there is more people who are wanting those shares and the supply is limited, the price is going to go up. On the other hand, if the company is not performing well, the company is going under losses, people will not want their shares. They will start selling it. That is, when more number of shares are available in the market and nobody is ready to take it, that is, the demand is low, that time the price is going to fall down. So whenever the demand is high, the price is going to be high. On the other hand, when the demand falls down, the price is also going to fall down. So that is how the price in the secondary market is going to fluctuate constantly. It is going to fluctuate throughout the day. And this you can check on the stock exchange. You can see the news. If you're seeing the news, you will get to know what is the price increase, price decrease. If it is increase, it will be in green. If it is decrease, it is going to be in red. So this is the constant fluctuation that takes place throughout the day. Now, once this price fluctuates, how will we know what is the value of the company? To determine that, we have a concept of market capitalization. What is market capitalization? It is nothing but the price of securities on the stock exchange on a particular day into the number of shares of the company that are in existence on the stock exchange of a particular company. This is the formula to calculate market capitalization. That is the price of the securities on the stock exchange into the number of shares of the company that will give us market capitalization. Right? So it is going to help in capital appreciation. To the investors, it is going to create wealth or income, whereas to the companies, it is going to help in increasing their market capitalization. Coming to the third difference is the scope. Here we are issuing new securities through IPO. Here we are only facilitating further trading by already offered securities to the public. Here another name is initial public offer market or the new issue market. Here we call it as the after issue market. That is nothing but the trading market. Here, purchase of securities, how does it take place? The investors will purchase the securities directly from the company. The transaction is taking place between the investor and the company. So the company is going to issue the securities for the first time to the investors. That is, the purchase is done directly from the company. But in the secondary market, one investor is selling his security to the other investor. So here, the transaction is among the investors themselves and the company is not involved. In the primary market, the company is directly issuing the shares to the investors, whereas in the secondary market, the investors are selling and buying among themselves. What happens with respect to financing? Primary market provides funds to new and old companies for expansion and diversification of their business. That is, in case it is a new company for the first time it is going to list it, then it is called as new company for which we are going to do the initial public offer. And if there is already existing company, old company, they want to do expansion and diversification, they can also raise money by making a further public offer. Right? Next. Financing in secondary market, it does not provide any funding to the company because why? There is no involvement of the company in the secondary market. What is the involvement? It is the parties or the investors among themselves who are going to do. There is no company involvement. So there is no funding or monetary gain that is happening in the secondary market for the companies. Coming to the parties to the transaction, here it is between the company and the investor because there is a direct relationship. Directly, they are going to access each other. Whereas in the secondary market, the parties are only and only the investors. The intermediary in the primary market is underwriter and the intermediary in the secondary market is the stockbroker or the brokers in general. Why? Because the investors cannot directly access the stock exchange. They need these brokers. Only if they are a customer of a broker, they will tell broker what they want to buy, what they want to sell, how much they want to buy, how much they want to sell. And these brokers are going to undertake those transactions on the stock exchange on behalf of these investors. So this intermediary in the secondary market is the broker. On the other hand, the intermediaries in the primary market are underwriters. What are underwriters? What happens in the primary market? It is that the company is going to issue funds to the investors for the first time. If the company is issuing securities, but the public is not ready to take those securities, in that case, what is the company going to do? How is it going to raise funds? So, to have a guarantee that in case the public is not going to subscribe to my shares, I am going to appoint underwriters. They are going to step into the shoe of public investors and make investment in the company. They will step in the shoes of investors and ensure that the initial public offer is successful. If the public is not accepting the shares of the company, these underwriters will help the company to raise funds. They are the people who are going to make investments. Coming to the price, here the price is decided by the company, or it is done through a red herring prospectus. That is, the company opts that we will take the opinion of the people about what is the demand and supply and go through the book building procedure. So in the primary market, there are two methods in determining the price. One is the fixed method, where the company itself is going to fix the price for IPO. Other one is the book building procedure, where they take the opinion of the public by asking them to bid for the price. And in the secondary market, the price is entirely dependent on demand and supply mechanism. Utilization of the money, all the money that has been raised in the primary market will directly become the capital of the company, whereas whatever money is received in the secondary market is the income of the investor, because he is buying or he is selling, so that is his income. So these are the primary 10 differences between primary market and the secondary market. Going ahead to regulation of capital market. Now, why is there a need to regulate the capital market? First and foremost, because it is the public funds which are involved. If the public money does not have safety and security, will public be interested in making investment in the capital market? Only if they get an assurance. They are assured that yes, our money is safe. Whatever investment we have done is secure. Only if they have this guarantee that the money that they are putting, somebody is there to have a check on it, that there are no frauds and scams that are taking place. So that is the primary reason for regulating this market, because mainly it is the public money at large that is being utilized in this particular market. Earlier, when the market or the stock market came into being, how did it start? It was hardly a group of 5 people who sat under a tree in Bombay and started these trading activities. Slowly that 5 people become 200 people. They bought a building. They started trading in that particular building. From a tree, they moved to a building. Then after a long period of time, over a period of time, they created the Bombay Stock Exchange, which is the first stock exchange of our country. Slowly, steadily, the stock exchange or the stock market has developed over a period of time. Earlier, there were no investment, but once this market grew, a lot of people started putting their money in the stock market. A lot of people were attracted to making investment in the stock market until a point in time that the companies were so sure that people are investing, they started entering into malpractices. That is when the trust that was gained was lost and people were hesitant to invest in the market. When the people, earlier there was no market as such. Then slowly the market has grown and it has developed over a period of time. And a lot of investors were actually investing in the market. Then came a point in time where many companies created scams, there were frauds, there were non-adherence, there were not following the rules and regulations that were created, etc. At that point in time, the investors again lost their trust. There was no trust among them that if we are going to put our money in this market, it is going to be safe. At that point in time, they thought that we need a strict regulator like a Securities Exchange Board of India, who should be given a lot of powers to ensure that these companies which are not following the rules and regulations, who are undertaking fraudulent activities, who are undertaking scams, they should be stopped, and all the companies which are raising money from the public at large should be regulated. There should be somebody who should constantly check on what these companies are doing, because they are using the money of the public at large. Right? So this is the need why they thought that this capital market should have a proper regulator, that is the Securities Exchange Board of India. So in the 90s, the development of stock market had attracted a lot of investment from individual shareholders. Once the market flourished, there were many malpractices like non-adhering to rules and regulations, price rigging, unofficial self-modulated merchant bankers, delayed delivery issues, etc. Because of which the investors felt deceived and they were losing trust in the securities. Right at this point in time, one major scam of the country, that is the scam of 1992, which is also called as the Harshad Mehta scam, took place. Here, what happened? A money of 4,000 crore rupees worth manipulations were taken place. At this point in time, the Indian stock market gradually crashed. When this particular information about this scam came out in the public domain, the market completely crashed because nobody was further making any kind of investment in the market. That this particular scam led to the statutory formation of the Securities Exchange Board of India. The Securities Exchange Board of India was in existence even before 1992. But it did not have a statutory recognition because there was no power that was given. Okay? As a measure of which the government sensed that there is an urgent need to regulate the smooth and systematic functioning of exchanges. And that is when they said that we have to give a statutory formation to SEBI. And that is when they passed the Securities Exchange Board of India Act of 1992. This is the statutory enactment through which we have established the Securities Exchange Board of India as the regulator of the capital market. Now, the capital market is not only regulated by the Securities Exchange Board of India, we have seen, but these markets are first and foremost regulated by the Ministry of Finance. They come under the Ministry of Finance. And under Ministry of Finance, we have the department, that is the Securities Exchange Board of India, as well as the Reserve Bank of India. Both RBI and the Securities Exchange Board of India come under the Ministry of Finance. This Ministry of Finance has a separate department known as Department of Economic Affairs and Capital Market Division, whereby they will regulate the securities market or capital market at large. This division, that is the capital market division, is responsible for, first and foremost, making policies for what? To ensure that there is growth of the market as well as development of the market. Now, why is growth and development so important? Now, over a period of time, from physical form of share certificates, we have moved to the demat form. What happens globally also, we should go ahead with the time. We should change with the changing circumstances of the situations, with the changing technology, with the changing in circumstances over the other countries of the world. We should also grow and develop accordingly. That is why constantly formally for policies should be made so that we ensure that there is growth as well as development of our securities market. Next one is protecting the interest of the investors who are generally public at large. Until and unless their interest is not protected, until we don't give them security and guarantee about their investment, we are not going to give them protection that their funds are safe. They are not going to make the investment. So you should take primary responsibility of protecting that the investors are safe. Institutional reforms in the market. Building regulatory and market institutions, right? Creating these market institutions and intermediaries is also necessary so that the entire market functions in a smooth and efficient manner. strengthening the investor protection mechanism. If the investor has any problem in the market, how are we going to solve the issue for them? How are we going to provide a platform that in case they have any kind of grievance in the market, some company is not adhering to the requirement of the investor, they are not answering the question of investors, where will those investors go? For them, we have a separate mechanism like the scores mechanism where they can raise their queries and file complaints if they have anything with respect to the securities market. So investor protection mechanism should be strengthened and providing efficient legislative framework for securities market. And this responsibility has been entrusted to the Securities Exchange Board of India, right? This is how we have evolved from not having a proper regulation to establishment of the Securities Exchange Board of India by the establishment or passing of the SEBI Act of 1990. Okay, like we have discussed, the market is regulated by the Securities Exchange Board of India and other regulators. I've divided into Securities Exchange Board of India and other regulators because the primary regulator is the Securities Exchange Board of India, and there are other regulators whose consultation is required by the Securities Exchange Board of India when certain policies or rules and regulations are passed by the board. It has to take in consultation with these regulators before passing any kind of rules and regulations. So briefly, we are going to see what is the Securities Exchange Board of India and what are their objective functions and powers. Okay. Yes. Moving to the primary regulator, that is the Securities Exchange Board of India. Like I told you, though the SEBI Act, that is the Securities Exchange Board of India Act, came into existence only in the 1992, but the Securities Exchange Board of India itself was established right in 1988 itself, before the scam took place. But that time it was not a statutory authority. It was only under an order that particular board was created, but it did not have a statutory authority. Okay, that is why it did not have a lot of powers and significance. That is when after the scam of 1992, they thought that it is important for us to pass a statutory act and give a statutory recognition and make it a powerful institution by passing of the SEBI Act of 1992. Before the SEBI, there was the Controller of Capital Issues. Now that has been repealed because the SEBI Act has come into existence. Okay, many powers has been given to the Securities Exchange Board of India. SEBI comes under the control of Ministry of Finance, like we have already discussed, and it has its head office in Mumbai. Now it has become a very important constituent of the financial regulatory framework. The most important thing is SEBI is the watchdog for all the capital market participants. Why? Because its main purpose is what? Protecting the interest of investors. So it should constantly watch that if any activity is going against the rules, regulations from any law that has been passed by SEBI, whether that is being complied or not complied by the market participants, it is going to constantly watch. And if at any point in time it is going to sense that something is wrong, it has the power to investigate that particular matter. So it, as its main purpose is to provide an environment for financial market enthusiasts and facilitate efficient and smooth working of the securities market. So if you want to have a smooth market, you should constantly check that nothing is going wrong. What is the objective of SEBI? Okay. The objective of SEBI is clearly divided into three aspects based on the preamble. Okay, the preamble of SEBI Act of 1992 says that it is an act which is created or passed mainly to establish the Securities Exchange Board of India. The entire SEBI Act of 1992 is for formation, giving a statutory recognition to the Securities Exchange Board of India. But why is there a need to establish the Securities Exchange Board of India? First is to protect the interest of investors, to promote the development of the securities market, to regulate the securities market, and for any other matter which is incidental to the above mentioned points. So by this preamble, we can establish that there are three main objectives of the Securities Exchange Board of India. The first one is protecting the investors. Second one is developing the securities market. And third one is regulating the securities market. So one objective is with respect to the point of view of the investors, that we should ensure that they are protected at all times, their investment is safe, their investment is secure, and we are giving them utmost protection from any kind of scam or fraudulent activities within the market. And the second and third point is with respect to our point of view of the securities market. It is very important that with changing times, we help develop the particular market as well as regulate by creating necessary rules, regulation, and laws to ensure that protection can be given to the investors. So development and regulation of securities market these are the objectives of the Securities Exchange Board of India. So the three primary objectives is protecting the interest of investors, developing the securities market, as well as regulating the securities market. Now, what are the functions of SEBI? Depending upon the three objectives that we saw, that is protection, development, and regulation, based on these three keywords only, the functions of SEBI has been classified. Okay, so for protection of investors, they have to carry out certain functions which are called as the protective functions. To develop the securities market, they have to carry out certain functions that are called as the development functions. And to regulate the securities market, they have to do certain activities which are known as the regulatory functions of the Securities Exchange Board of India. Whatever points are mentioned here under the functions are only an illustrative list. Over and above this, they have a lot more powers and functions that they can do. First and foremost, talking about the protective function, the functions can be performed by the SEBI to protect the interest of investors and other participants. How can do it? It is only including, this is only examples through which you can ensure protection of investors. Checking price rigging, prevent insider trading, promote fair practices, create awareness, and prohibit fraudulent activities. It is only an illustrative list. Development functions can perform certain development functions that include but are not limited to. Like I told you, it is only an example of what are development functions. Imparting the trading to intermediaries. How should they carry on their functions? How can they help the investors invest in the market? How will we ensure smooth functioning of the market by establishment of the intermediaries? To them, training is required to be given, and that training is given by the Securities Exchange Board of India. Promotion of fair trading and reduction of malpractices, carrying out the necessary research work about what is happening in the other parts of the world, right? How we can further improve our market. If they found a particular error or a defect in the market, how can we rectify it? Such a research work is required. Encouraging self-regulatory organization, buying and selling mutual funds directly through the asset management company through the brokers. These are the development functions. Talking about the regulatory functions, these functions are basically performed to keep a check on the functioning of the businesses in the market. For that, we have proper code of conduct of what the financial intermediary should do, what the corporate houses should do. In case there is a takeover regulations are there. In case there is anything that is going wrong, we have the power to conduct inquiries and audit of the stock exchanges. We have various registration requirements for all the intermediaries, brokers, merchant bankers, depositories, levying of fees, performing and exercising of any other powers, register and regulating the credit rating agencies. These are all the regulatory functions of the board. Like I've already mentioned, these are examples in which they can ensure that these can be fulfilled. Moving ahead to the powers of the Securities Exchange Board of India. So the powers of Securities Exchange Board of India, before going to the powers, it is important for us to understand what are the organs of the government. Right? Under the Constitution, we have the three organs. One is the legislative, we have the executive, and we have the judiciary. What does the legislative do? It makes the law to ensure that the country is regulated properly, right? Whatever areas of regulation are there, rules or regulations are required, this legislative authority is going to pass or make the rules and regulations. We have the Parliament to ensure that these activities are taken place. What is the executive authority? It is the authority who is going to implement the laws that have been created by the legislature. And judiciary is, in case there is any kind of doubt or confusion, we are going to interpret the provisions of law and solve any kind of disputes arising on the basis of the law that has been created or passed. So this is the basic organs of the government of India. But when we come to the exact sectoral sector, like if you're talking about specifically the capital market, are the people who are sitting in the parliament more well-versed about what is happening in the market, or SEBI being the regulator, SEBI has more in-depth knowledge or details about the market? It is the people who are in direct control of that particular market, who have a better understanding of the market, who have a better knowledge about what should be the law. If they're finding something difficult and they want to give a solution to that, it is the Securities Exchange Board of India which will be in a position to give that particular solution, because they are in direct contact to the market rather than people who are sitting in the parliament. So the overall framework can be done by the legislature. But when we are talking about one specific market, the primary direct regulator of the market will be in a better position to make the rules and regulations. That is when certain of these powers are delegated to the regulatory authorities. Okay, and this delegated authority are the powers of SEBI. What are the powers of SEBI? They have quasi-judicial powers. They have quasi-legislative powers. They have quasi-executive powers. So these are the three functions or three organs of the government: judiciary, legislative, and executive. The same functions are also given to the Securities Exchange Board of India. But since they are not the primary authority to pass the law, execute the law, and implement the law, or give solutions to the problem, they are only having the delegated power. That is why we use the word quasi before these words. Quasi means like, okay? It is similar to the powers of legislative power, similar to the powers of legislative authorities, similar to the power of the executive authorities. So they have delegated powers to carry on judicial, legislative, and executive powers of the country. So SEBI has the power to conduct hearings and pass orders because it is a judicial, and this ensures transparency, fairness, and accountability. Legislative power, they have the power to draft rules and regulations for protecting the interest of investors. Using this power, SEBI has created multiple regulations: SEBI ICDR regulations, SEBI LODR regulations, SEBI SAST regulations. There are multiple rules and regulations which are created by SEBI using this quasi-legislative power. Third one is quasi-executive power, whereas it has an authority to file a case against anyone who's violating the rules and regulations, right? So it has the power to inspect any documents and trace any kind of suspicious activity in the interest of the investors. And fourth power is slightly different from the other powers, where SEBI has the power to issue informal guidance. What is informal guidance? Now, SEBI has passed multiple rules and regulations using the legislative power. Now, people who have to implement these rules and regulations, people who are required to do a particular activity, like various participants who have to follow these rules and regulations, they will have some kind of doubt with respect to interpreting the provisions of law. What a particular rule or regulation of SEBI regulations say, they are not able to understand how to interpret that particular activity, or in a particular given circumstances, facts of the case, if they have to do a particular act, if they want to go for an IPO, whether they can do or not. So based on the facts of their own case, they are not able to understand. They have any kind of doubt. At that time, using this informal guidance scheme, they can approach the Securities Exchange Board of India for clarification. So SEBI is going to give them clarification in the form of informal guidance. So SEBI has the power to issue informal guidance to the participants of the market who have any kind of doubt with respect to applicability of the rules and regulations passed by the Securities Exchange Board of India. So for this, they have passed a SEBI informal guidance scheme of 2003, whereby any participant in the market who is registered with SEBI can make a request to the board asking them for informal guidance. So the department of SEBI is going to solve any kind of doubts that you have with respect to interpretation of the provisions of the Securities Exchange Board of India rules and regulations, or in case you want to know on the basis of facts and circumstances that are applicable to you, will there be any impact with respect to the rules and regulations. So there are two ways in which informal guidance can be given. One is through the no action letter. Other one is the interpretive letter. So depending upon what doubt you have, you can make an application seeking either no action letter, or you can ask for the interpretation of a particular provision. So the four main powers of the Securities Exchange Board of India are quasi-judicial power, quasi-legislative power, quasi-executive power, and the power to issue informal guidance. Okay, that brings us to the end of what are the objectives of SEBI, what are the functions of SEBI, and what are the powers of SEBI. The objective and functions remain the same, that are three. That is the protection of interest of investors, development of the securities market, and regulation of the securities market. And powers, there are four powers. It is quasi-judicial, quasi-legislative, quasi-executive, and lastly, the power to issue informal guidance. So this is a brief of what we have discussed about the primary regulator, that is the Securities Exchange Board of India. Right? So we have discussed the basic aspects of the capital market, how it is classified into securities market. Further, securities market is classified into primary market and secondary market, and thereafter, who is the regulator of this capital market. By this, we come to the end of the session where we have discussed the introduction to capital market. If you all have any doubt with respect to any of the topics that have been covered in this session, you can leave them in the comments and we will get back to you with the clarification. And until then, we will see you in the next session.